Hello guys, welcome back to the channel. This is MD Investor, the channel where we're talking about personal finance, setting and achieving goals, breaking the cycle of generational poverty. Thanks for the subscription on YouTube with MD Investor. Definitely subscribe so whenever new content comes out, you'll be alerted. On Instagram, it's MD Investor 1. So let's get into it, guys. Last video, we talked a little about dividend stocks, and it's a great way to make passive income. This video, I figure we'll talk about some terms to be familiar with when dealing with dividend stocks. Some terms you want to be familiar with when you are researching dividend stocks. The first term you'll see a lot when you're studying dividend stocks, and as we begin to learn and get into it more, is going to be dividend aristocrats. Dividend aristocrats. These are stocks that have increased their dividends for at least 25 years. And they're also part of the S&P 500, which is, you hear about S&P 500 in the news all the time. Standard & Poor, it's a list of the 500 biggest companies in America. So dividend aristocrats are stocks that are part of the S&P 500 that have increased their dividends for at least 25 years. The next term you might hear is, you might hear the term Dividend Champions. Dividend Champions. These are companies that are not necessarily part of the S&P 500, but they have also increased their dividends for at least 25 years. So dividend champions are similar to dividend aristocrats in that they have increased their dividends for at least 25 years, but the dividend champion differs from the aristocrat in that they are not necessarily part of the S&P 500. The next term you'll hear is dividend kings. Dividend kings are S&P 500 companies who have increased their dividends for at least 50 consecutive years. That's 50 consecutive years. Talk about stability. So, we're getting more exclusive. Now, we're going to talk about a couple of dates. We're talking about 4 different dates that you will hear, and we'll talk about in this channel. The first one is the declaration date. When you go on all these websites, you're going to see the stock ticker symbol, and you're going to see the declaration date. The declaration date is simply the day or the date that a company declared we're going to pay a dividend. So the board of directors get together, have a meeting, and they decide on this date that we're going to pay a dividend. They say how much they're going to pay, and they also say when the payment date is going to be made, and they also talk about when the ex-dividend date is going to be. We'll talk about that in a minute. So the declaration date is simply the date that the company makes the declaration or the announcement that we're going to pay a dividend. It's also called the announcement date. The second date that's important is called the ex-dividend date. I kind of alluded it to earlier. The ex-dividend date. The ex-dividend date. So what is the ex-dividend date? The ex-dividend date is the date that if you buy the stock on that date or after, you are not entitled to the previous dividend. So let me repeat it again. If you buy the ex-dividend date, is the date where if you buy the stock on that day, you are not entitled to the dividend. Okay? So on the ex-dividend date, buyers of the stock are not entitled to the dividend. The stock is considered to be trading ex-dividend that date, meaning it's trading without its dividend. So quick example to kind of get this in our mind. So you have a company, ABC Incorporated, and they declare they're going to pay a $1 dividend with an ex-dividend date on January 10th. If you buy ABC Company on January 10th, 11th, or 12th, and meaning on the ex-dividend date or after, you're not entitled to the dividend. If you buy the company before the ex-dividend date, in this example, January 10th, you buy it on January 7th, January 8th, and January 9th, you are entitled to the dividend. So that's it. Ex-dividend date is the cutoff, essentially. Ex-dividend date is the cutoff. If you buy the stock on that date, you are not entitled to the dividend. So essentially, for us dividend investors, we're going to want to buy our stock before the dividend date. Okay, guys? Before the dividend date. The next date is the record date. The next date is the record date. What is that? That's basically the date when the company looked at its record and determines who are we going to pay the dividend to. Who are the stockholders of record that have held the stock before the ex-dividend date that are eligible for the dividend. That's basically what it is. The ex-dividend date, the record date is always the next business day after the ex-dividend date. So the ex-dividend date is, in our last example, use January 10th. The record date is going to be the next business day. Okay? So the next non-holiday or non-weekend day, that's going to be the record date. For us, we're going to be long-term, buy and hold, solid companies, not going to be trading and flipping and buying. Doesn't really matter to us, really. The main date for us is going to be the ex-dividend date. When do we have to buy this stock so we can get the dividend? Okay, the next date that we're going to want to be aware of is the payment date. Hey, that's the main thing right there. The payment date. I'm getting excited. I'm knocking on my water. The payment date is basically the pay date. The day the company goes out and actually pays us our passive income, pays us our cash, where we can sit on the beach and see the money coming into our account. The payment date. Couple of terms I want to mention to you guys that as dividend investors we're going to want to know. Dividend yield. That's going to be big. Dividend yield. So you have a company that is trading at $100 per share, and they pay you out $1.25, $1.25 every quarter, every 3 months. So for the year, they pay you a total of $1.25 times 4, right? There's 4 quarters in a year. That equals to $5. So the way you get the dividend yield, you put the dividend paid to you over the year, over the stock price. So in our example, our stock price is $100 per share, so it's going to be $5 in dividends per year divided by $100 of the stock price. Our dividend yield would be 5%. That's how you calculate the dividend yield. And that's a much better way to compare company A versus company B. What's the yield? What's the yield? Because a company might be paying out 30 cents a quarter or $1.20 per year, and another company may be paying out $1.50 per quarter or $6 per year. Which one is the better one to buy for dividend growth? I said, well, $1.50 is a lot better than 30 cents. Yeah, but if that company that's paying out $1.50 per quarter costs $400 a share, you might have a much lower yield. So the dividend yield is a much better way to compare company to company. Okay, got dividend yield. And the next thing we're going to want to know is, you'll hear on all these videos and all these websites, it's called the payout ratio. The payout ratio, they're talking about the payout ratio. The payout ratio simply is the ratio of the earnings per share being paid out as dividend. So a quick example, a company say that their earnings per share is $1, right? So for every share that company has, it's making $1. And they're paying out 40 cents per quarter, or every 3 months, 40 cents out of that dollar. So the pay ratio would be 40%. They're making $1 per share, and they're paying out 40 cents out of that dollar in dividend. So 40 over 100 is 40%. The payout ratio was 40%. The reason why the payout ratio is going to be important for us guys is that, think about it. If a company is making, say, $1 in our example, earnings per share making $1 in earnings per share, and they're paying out 95 cents in dividends. That's a 95% payout ratio. There's not much room left, right, for the company to invest in research and development, maybe acquiring other businesses, other things the company may want to do, because they're stretched too thin. They really there's no margin. If anything was to happen in that company, sales slows down, anything can happen. There may be some scandal in the news with the CEO. For example, look what's going on now with Boeing, right? They had a couple of plane crashes, and all of a sudden the stock is plummeting. A lot of bad news. The stock can plummet. A lot of people have canceled their orders of ordering Boeing planes. So what happened? That means their earnings per share is going to drop. And now maybe the dividend is going to be 100% or over 100%. So the lower the payout ratio, the better. Meaning that there's room, the company has room to maneuver in case anything will happen. The cost of goods and supplies goes up. The cost of paying the employee or labor wages goes up. Anything can happen. There's room in there for the company to adjust. So in general, you want the lower payout ratio, the better. With certain exceptions, in certain sectors, for example, the utility sector is the sector notoriously for having a very high payout ratio. Okay? But in general, you want a lower payout ratio. 50%, 60%, where there's room for the company to operate. So there's a quick video today, guys, about terms we got to be familiar with in investing in dividend stock. We're going to continue to learn and grow and make passive income. So just remember, guys, the terms today we went over: dividend aristocrats, stocks that have increased their dividend by at least 25 years, and they're part of the S&P 500. Dividend kings, these are companies that have increased their dividends by at least 50 years consecutively, and they're also part of the S&P 500 companies. The dividend champions, or companies that have increased their dividend by at least 25 years, but not necessarily part of the S&P 500. The declaration date, the company declares that it's going to pay its dividend. The Exdividend date is if you buy the stock on that date or after, you're not entitled to the dividend. You have to buy it before the Exdividend date. And then the last two dates we remembered were the record date, the date of record. And if you're a shareholder of record, then you will get paid the dividend. The payment date, the date we get paid. The dividend yield is the amount of dividend you get paid per year over the current share price. That's a good way to compare apples to different companies. And the payout ratio, guys, is the ratio of the dividend that the company is paying out to the earnings per share. And we say in general we want a lower ratio. Okay, something about 50%. So there's a quick video, guys, about terms we want to be familiar with in dividend stock. We're going to continue to grow and learn and make passive income. If there's people out there, guys, who you think could benefit from information, definitely feel free to send them the information. Don't forget to subscribe to be updated and to be alerted to new videos coming out on YouTube. That's MD Investor, and on Instagram, MD Investor 1, guys. We'll see you on the next video.